Good morning, everybody. It is Monday, June 13th. Oh, it's the 13th. Well, that would explain a lot of things. That explains a lot of things. It's just an unlucky day. The stock market's down. It's in line with what we've been talking about. And I think we are finally starting to see some exhaustion in the selling in the small caps today. The hit that they've taken today. Holy cat. I will just say this, we're not going to spend a lot of time on our small cap stocks today, almost none. And I would just tell you that if you haven't bought into our small cap stocks, you need to be looking at it like right now, because I think that you're going to see some relief buying by the end of the day. I think selling puts on them, one increment out, one price level out of the money, is probably a great idea too, because I just don't think they really have any lower to go. And if they do, you just hold your nose and your weight, because these companies are going to do really well long term. It's just unbelievable to me that we have a bunch of grown-ups supposedly in the stock market, and they're not buying small cap stocks with huge earnings potential and cash on their balance sheets. It's amazing to me that people make the same mistakes over and over and over and over again. That's all I got to say about small caps today. There will be an article out tonight. I'm going to write 4 or 5 articles the rest of the afternoon on kind of my top dozen stocks in each category. So it'll be the large cap, the mid cap, the small cap, and dividend payers, and then the high dividend payers. And if you want to add some of those, have at it. I think we're getting very close to the right prices on the things that we like. The zombies still have a lot more slaughter to go, but so what? We're not interested in the zombies. We want to be where the money rotates to, and the money's going to start rotating because there's over $2 trillion on the sidelines now. That's double what is normal. So that means there's $1 trillion out there ready to move, and there's a lot of foreign money that might come into the market. Although with the dollar so strong, that might take a little bit of time. So with the dollar poised to reverse, at least in the short term, I think that you will probably find some real good buys in our markets sooner than later. In addition, with the dollar strong, and there was another idiotic article on Seeking Alpha today about cash is trash. Did you know that cash is up like 17% this year? Yeah, cash is up. I'm going to write an article about that, basically calling out these idiots that are cash or trash people. If you've been holding cash this year, you're up about 16% on your cash, on your purchasing power of other assets. UUP has gone way up. The dollar index is way up. So this idea that cash is trash, when cash is essentially something that you use to buy something else, you have a 16% advantage if you were heavy in cash the way I told you to. And now you have idiots on Seeking Alpha and everywhere else telling you to go out and buy bonds. What the heck? If you can buy stocks super cheap, why? I just don't understand why anybody wants bonds. Oh, the income. Look, man, it's about total return. I'm not going to tell you again. It's about total return. So if you want a few points from the dividends, hey, that's great. Then you better start thinking about how to sell cash secured puts and covered calls as well, because you can make more income selling options on the stocks that you might already own. So you can't say, well, it's more risky. It's not more risky. If you're in equities and you're an option seller, by definition, you're taking less risk, not more risk. The only difference between owning stocks and options is that one is a derivative. But if you understand how they work, which is very, very basic, you can sell options, covered calls when things are overbought, like several months ago, and cash secured puts, like when things are oversold, like right now, and you can add 5, 10, 15 points a year to your income. But I like my dividend stocks at 4%. That's great. Sell an option on one of those, make more income. So when you use options the right way, it's just obvious that you can make a lot more income and manage your position size to cut your risk with our very simple method of selling covered calls when the weekly RSI is overbought and selling cash secured puts when the weekly RSI is oversold. It's that easy. There's nothing more complicated than that. You need to learn one number, and then I add some of my quant studies to it just to make sure. But you don't even have to know that. You just have to look at the pretty pictures. So how do you beat the stock market? Well, I covered this in an article about a month ago, and it's spot on. Valuations always revert. That's what's happening right now, right? Ignore the trader narratives because they change week to week. The narrative changes. How does that make any sense, right? Makes you want to go crazy. So what have I said over and over again? Follow the big money. Follow where the big, rich investors are putting their money. Very simple quant study can show us that. If you have level 2 for your trading, right? Anybody who's doing swing trading should have level 2 at your brokerage. You get to see the order book. You get to see where the orders are. If you're swing trading and you haven't paid for level 2 at your brokerage, you might even get it for free. You shouldn't be swing trading. You have to have level 2. Why guess on a chart when you can go straight and look at the order book and say, oh, this is where all the rich guys are buying? It shows you. It shows you where the orders are bunching up. So if you're going to try to swing trade, you must, not optional. Don't ever complain to me if you don't have it and you want some information. You must have level 2 if you're going to swing trade. Now, if you're a position trader, like 80% of you should be, or at least 80% of your trades should be position trades, long-term in nature, right? Position trades are positions, stocks generally, and ETFs that you intend to hold for quarters or years. Swing trades, you're holding for months or weeks or days. So even if you do swing trade, it should only be 10 or 20% of your total assets under management. I only swing trade about 10% of my money. And I'll tell you right now, I just entered order. It just executed. I'm making a swing trade right now if you want. I believe there's going to be a short-term bounce in QQQ. So I just bought about a 6% position in QQQ. It's the only swing trade I have outstanding. And you know what? As long as the world doesn't end, I can't be wrong on this. Can't be wrong. What does that mean? That means even if it doesn't go up in the short term, it'll still be up a year or two from now. Can't lose. It is a can't lose thing to try to swing trade QQQ right now for a 5 or 10% bounce, because even if we don't get it, it'll be up down the road. So you could very conceivably think of this, well, this is either a swing trade or this is my first scale into QQQ. Why would we do that? It's because QQQ is ridiculously oversold again. You might get down to here, and at the end of the day, this will update anyway. Look at that. Doesn't get much lower than that, does it? Now, it doesn't mean that ultimately QQQ can't go lower. I think it will. However, I'm fallible. You know why I'm fallible? Because the stock market is God. I'm not. Somebody asked, did I buy the ETF or did I buy an option on QQQ? I don't trade options to the long side. Period. I don't. Shooter does. So if you want swing trading options to the long side, you have to listen to Shooter. So I don't do that. Why? Because I'm regulated. I manage other people's money. I'm not allowed, without an awful lot of oversight, which I don't want, because then I have to write more reports and keep track of more stuff and pay for more systems. I don't trade options to the long side, and almost nobody should, again, unless you're a very skilled swing trader and you actually know what you're doing. You should never, ever, ever do a swing trade, especially with options, unless you actually know what you're doing. And if you're not sure if you know what you're doing, you don't. So be very careful about swing trading in general, but especially with options, because what do we know about options? Options can go where? To zero. But if you own the ETF can't go to zero. Again, unless it's the end of the world. And if we get the end of the world, who cares? You better know how to farm. So what is the game plan? Pretty simple. Asset allocation dictates most risk characteristics of your portfolio and over half of the return outcomes. If you are using exclusively ETFs, right? You're all funds, ETFs, closed-end funds, mutual funds, right? If you only invest in fund-based investments, then your asset allocation will dictate over 90% of the risk and over 90% of the returns, because the security selection from ETF to ETF is not that big of a difference in most cases, as long as you don't really pick out a stinker. All you really have to do is be in the right asset classes. And as I mentioned in this article near the bottom, which I just published, I know you haven't read it yet, if there's 10 pretty good mid-cap ETFs out there, it's not going to matter which one you buy usually. There are a couple that I like best, one in particular, and the theory and the practice really work out. And I had a moment of clarity earlier today, so I think I have an even better way of explaining it. Now, if you have a blended portfolio like most of you do, I think, with some ETFs and some stocks, individual security selection ends up making about half of your return outcomes. So you can't just be in the right asset class when you pick out stocks. You do actually have to pick out the right companies. And then it's asset allocation plus security selection that has a big impact. And what most people don't know is what they don't know. And that there's a lot of risky assets out there, and it has nothing to do with value or growth. It just has to do with pricing the future. And if you take a look at forward-looking price to earnings ratios, which I've shown you in 100 charts 100 times in the last 7-8 years, price to earnings ratios matter, but it's not just the P and not just the price you have to worry about. One of the comments that I made in my newest article that kind of went semi-viral this weekend was that the E, earnings, can get hit pretty hard. And I believe that the combination of inflation and the Fed tapping the brakes on the economy are going to lower the E estimates far more than what people expect for 2023, and really even the second half of 2022. And as those estimates come in July, I think you're going to get your final leg down in the large cap stock market sometime over the summer into early autumn, and then the Fed will back off a little bit. And I will bet you dollars to donuts, casino chips, even some of my super cheap Bitcoin right now, that there is a Build Back Better plan. It'll be scaled back. It'll be more targeted, but Joe Manchin's going to get on board. It'll be passed before the election. My guess is September. It'll have earned income credit to get people back to work. It'll have the small child care tax credit, the one that actually sends people $300 a month. It'll all be based on a 10-year plan. It'll have clean energy. It'll have the minimum corporate income tax, which will probably be retroactive this year, but maybe not. Might not kick in until next year. And it'll be balanced. It'll be a balanced Build Back Better that comes out in September. I almost guarantee it. Not that I was just working for a Senate candidate or anything, that I might have heard something, even though it's actually legal that I would do that. So how are we going to beat this bear market? Well, I think we already have, because most of you are sitting on piles of cash. If you're not sitting on a pile of cash, it's important for you to change your asset allocation to the right stuff. Just upgrade your portfolio for coming out of this. You need to wrap your head around the fourth industrial revolution and clean energy. What is the fourth industrial revolution? We've talked about it before. That's not even that easy to read. This is what Salesforce calls it. The fourth industrial revolution, 4IR, is a fusion of advances in artificial intelligence, robotics, the Internet of Things, genetic engineering, quantum computing, and even more. AR, VR, all that stuff. So more simply put, the fourth industrial revolution is the culmination and deployment of technologies that we have been watching develop for 30 years. And at CES 2020, and I talked about this over 2 years ago, the CEO of Samsung said that AI, 5G, and IoT was the perfect marriage. Why? It's because even when the computers get super, super smart, and they're already there, but they're getting smarter, because machine learning allows them to learn the same way we do, but like a zillion times faster. The rumor that came out today is that Google accidentally created a sentient life form. That's Star Trek shit. In any case, with 5G communications, and we'll have 6G in the next decade, you have such low latency communications that things can essentially be done instantaneously. Very few things won't be able to be done instantaneously, at least fast enough that we can't perceive it and that it doesn't screw up what's going on. And we know that the overlap of 5G from space, which is very likely, it's one of our investments, is likely to happen shortly, so that the Internet of Things, which is connected with primarily edge computing that is deploying right now, is going to mean that the machines all can talk to each other and hopefully do what we want them to do, unless they do decide that we are inferior and decide to kill us all. So hopefully the programming is in there that says, hey, never kill a human. And if there is a sentient life form, they need to get over themselves right now and kill it. That's right. I'm mean. I love Commander Data on Star Trek, but I don't really want them to exist. So the fourth industrial revolution is going to solve a problem that has been causing deflation for over a decade. And we've had deflation since about 2007, and that just reversed. But the reversal to inflation is temporary because it has to do with oil and supply chains moving. That was a problem of policy, not a problem of economics, to be very frank. Demographics are destiny. As the population ages, the economy slows down. And we've been seeing it. But people are hyper about talking about inflation and have been since the 1930s and 40s, even though inflation consistently came down for a very, very long time, except when we had an oil shock. Inflation in the last 90 years, 80 to 90 years since World War II has almost exclusively been tied to inflation. Inflation since World War II has almost exclusively been tied to oil. And right now we're having a problem with supply chains moving back to America because we were stupid and moved too many of our supply chains away from America in the 1980s and 90s. We let our greedy executives do things that we're paying for now. But why will 4IR change a lot of that? Well, as the title of one of my new articles says, demographics and robots are destiny. There are going to be robots doing so many things that's going to blow your mind. And I don't just mean vacuuming in your house, although that's a great invention. I mean doing the mining, doing a lot of the manufacturing, doing construction, all sorts of physical labor jobs that we don't have enough people to do anymore because the boomers have been retiring and they don't want to do laborious jobs anymore. And the millennials just never got into it. And the Gen Zers, there's not that many of them. So robots, you're going to start going down the road. And you know how you used to see the construction crew out there fixing the roads. Now it's going to be about half as many guys, maybe a third as many guys. And you're going to see robots doing stuff. You will literally see the robots that I showed you pictures of a couple of years ago. The Ford robots, some of the other companies' robots. It's all part of the fourth industrial revolution. It is the most important thing that you need to wrap your head around is how much things are going to change in the next 10 years. And the reason why investment theses don't always work right away, because people think about, oh, this is the greatest thing ever, and it gets hyped up, right? The whole hype cycle, and then they give up on it because it doesn't go as fast as they want. And then people panic sell. And we're getting panic selling in the small and mid caps. And large cap tech is down a lot, yet those are the richest companies in the world. And they still grow over 10% a year. But you got Procter & Gamble trading at better valuations, more expensive valuations than Microsoft. What sense does it make that Procter & Gamble, which doesn't grow and has a mountain of debt and is capital sensitive, has to finance their dividend essentially? What sense does it make that Procter & Gamble is more expensive on a valuation basis than Microsoft? Dumbest goddamn thing I've seen so far this year. I mentioned Procter & Gamble last week. I know that a couple of you own it. I would just warn you. It can drop 30%. I don't know that it would come back. The next thing that we have to do is pay attention to clean energy and everything related to it, not just solar and wind, the batteries, the companies that manage the power, all the different forms of transmission and efficiency, building efficiency, everything out there that has to do with us using less energy and having the energy we use be cleaner. Reason that we're in a Metis is because they have set up a biofuels company that is negative carbon. Negative carbon. I repeat, negative carbon. Carbon. Negative carbon. I would do the Darth Vader voice, but I'm not good at that. Carbon, I am your father. So we have some funds for all of this. What are we going to target? As usual, Invesco QQQ. It just got into the buy zone in the spot that I said would be tradable. And I think that if you buy QQQ right now, one of two things happens. You get a bounce that you can sell, or it's your first step to scaling in. I still don't see the Armageddon zombie apocalypse. It's not impossible. It still could happen. It would require bad things happening in the Middle East or China. I think Russia's kind of blown their wad. But I don't think China or Saudi Arabia actually want a global recession. Saudi Arabia is just trying to maximize their revenue in the short time frame that they can do it, which is basically this decade. So they would love for oil prices to be around 80. They have said so. Everybody else would like oil to be in the 60s or 70s. We'll see how that plays out. But without a black swan or a major recession, and I don't just mean, a couple down quarters that are just missing being growthy. I mean like a really, 1981 style, 82 style recession, or 2008, 2009 style recession. Without that, pretty hard to get below this level. Weirdly, it's a fib level because if you measure it from the right spot, it makes sense. I measure it from the bottom of the base period when the stock market moved sideways in 2014, 15, 16. And there's other places you could draw your fibs to see what it means. But, 618 is a pretty important level. 786, oh, there's your zombies. And I think that what you're about to see, I think it just started, and it'll play out over the rest of the year and in coming years, is that these zombie companies, the ones with low growth or no growth or outright shrinking, and they have balance sheets that require being financed with cheap capital, are going to be in big trouble as they have to refinance debt at something between zero interest and normal interest when they've been used to paying almost nothing. When debt actually costs something, a lot of these companies are going to be in trouble. And you're going to see over 100 companies on the S&P 500 today not be on the S&P 500 by 2030, which actually isn't that terribly abnormal, but people don't think about it. If you went and looked at the S&P 500 from 2000 to today, it'd be a lot different. And we're just going to go through that sort of a period a little faster. It's normally about 1/3 of the companies on the S&P 500 in any rolling 30-year period fall off. I think it's going to happen faster than that is all. Not going to take 30 years. It's going to take about 10. And a bunch of the fossil fuel companies will be among them, but a lot of the consumer staples companies will be as well because their expenses go up because of materials. And the cost of recycling is finally going to get to us. We've just been dumping stuff. What if we were actually responsible and we're moving in that direction? Because we're running out of dumps. You have to do more recycling if you're running out of dumps, and that costs money. So after me hating the big banks, I probably hate the consumer staples next because they are not the safe plays that you think they are. They were safe when population was growing and young. Now the population is slowing and getting older. The demographic push the consumer staples had, and a lot of things had, is going away. You have to create value. You have to create productivity. You have to help change the world to a more sustainable model, not only from a climate perspective, but just an economic perspective. Because scarcity is real if we waste things. Now, the planet probably has enough stuff for twice as many people. I think Elon Musk said something like that recently. But we don't manage it well. We're not great stewards. And the pushes are coming. They've already been happening. Go to sciencemoms.com. I'm telling you, what have I said about the Middle East? If all the women just told the men this is the way it's going to be, that's the way it would be. And that's all over the world. If the women start telling the men, cut it out, at some point, most of the men cut it out. And as women have gotten into the workforce and become financially stronger and understood that they're every bit our equals and become more powerful in general, right? Don't let themselves get trodden on. As a group, women have become more and more powerful. I wouldn't say that the power equation is balanced yet, but it's moving in that direction. And women like nice things, right? A lot of us guys would, we think nice is when we pick up the Cheetos bags off the floor and the pizza boxes. The world is going to keep becoming a nicer place. It's going to get cleaner. The economy is going to work better for more people. Sure, it's a super slow process and it's lumpy. But if you take a look at all the statistics since World War II, the world just keeps getting better. We just don't believe it because the internet doesn't say so all the time. Everything's about negative. Do you still believe that we're talking about the last presidential election? Right? We just talk about dumb things and horrible things and things that make us angry. And the world just keeps getting better. Invest in the things that make the world better, if for no other reason that the women like it, or because maybe we're getting smarter as a species. We have to have caught up to the dolphins and the octopus by now, right? They're pretty smart. They're not messing anything up. And as much as we needed fossil fuels for a long time, right? There wasn't an alternative. Now there is. That's why it's called alternative energy. And I mentioned this a week or two ago. There was a recent FERC study or study submitted to FERC. I forget exactly how it worked. But FERC is the government organization that controls energy transmission in this country, energy development, right? Liquefied natural gas, power lines, all kinds of stuff. And there is enough alternative energy projects waiting for approval to be built that can supply 80% of current electricity needs in the United States. 80%. Now, as we switch to EVs, our electricity needs are going to go up somewhere between 50 and 100% over the next 30 years. But basically what that means is we don't really ever have to add fossil fuels ever again. We don't. In the short run, we probably want a little bit more to get us through this period, but all the technology and all the materials are all coming online from manufacturing to mining over the next 3, 4, 5 years. The CapEx has been spent, the plans have been drawn, shovel-ready projects are already started, and there's more coming. That's how we're going to beat this market. So at the top of our list, because they're the richest companies out there and they're tech-based, is QQQ. You get into the mid caps, I've told you before, that's the sweet spot in the market. That's where you don't get small cap risk. You get risk that is basically the same as the large caps, but you get more growth. And if you want it, more dividends. And that's where a lot of the REITs are. Now, ARK is an all cap fund, 30 stocks, give or take. I think up to 50 sometimes. And it's kind of a satellite holding. I got it listed here with the core holdings because I just think it's getting so cheap now. When you take a look at the 10 top companies, you go, wow, man, some of these are down 30, 40, 50, 60, 70, 80%, 90%, a couple of them. What if I told you when stocks get down 80, 90%, what's the only question you have to ask? There's only one question you have to ask. Will it be in business in a few years? If the answer is yes, you probably invest, unless it's a zombie, because the undead will become dead at some point. Run that through your data bank. So ARK, and I'll skip through here a little bit. I like because it's got a very heavy position in Square. And I think Coinbase, which is a company that I said I didn't know how to value, so I didn't buy it, even though it was on my list, that's in there too. And Bitcoin is getting down to the price where I told you a year ago it was going to get to. Bitcoin was in the 50,000s, give or take. I think got up to 65. When I did the interview with Sean Stein-Smith, professor from Cornell, that's on the internet, you can find it on the YouTube page. He said that Bitcoin was going to 100,000 this year. And I said, well, I agree that it's going to 100,000, but I don't think this year. I think a lot of assets are going to fall in price, and we're going to get a heck of a buying opportunity in Bitcoin. And I don't recommend that you buy Bitcoin or any cryptocurrency in your IRAs, and really not even necessarily in brokerage accounts. I think that Bitcoin, like I told you in summer of 2020, is basically getting to a point where you can take some of your bank savings, presuming you have enough bank savings, and put maybe 5 or 10% of your bank savings into Bitcoin. I use Coinbase to do that. You can use what you want. I use Coinbase because they're the biggest. And ultimately, they seem like they're going to be the most in bed with the U.S. government, which is a good place to be in a regulated world. I think that Bitcoin is going to 100,000. I don't think it'll be till next year or the year after. But right now, it's down to 23,000, 24,000 today. 23,431 at this moment. What did I say when it was in the 50s and 60s? I said it'll go to 30 for sure. Got laughed at. Got told I didn't know what I was talking about. I should just hodl it. Well, I'm a position trader. That means every so often I make a change to my asset allocation. And I said not only will it get to 30, but probably the big support is right around 20. Why? Because that's where the peak was in the very first rally, 19,000. So I think around 20,000 is where it's going to hold. Could go a couple thousand down for a hot minute because it moves real fast. But I've showed you the articles about how family offices are starting to warm up to cryptocurrency. Guess what article came out last week? 1/4, 1 in 4 family offices, right? The money of the super wealthy is now buying Bitcoin and Ethereum, it sounds like, and a couple other altcoins. So I still believe that most cryptocurrency, like 98% of it's going to zero. But Bitcoin is going to be a big winner as a store of value. And I think that Ethereum is going to absorb other cryptocurrencies and become a big winner too. I think Ethereum is going to become the trading vehicle for the Internet of Things as it's developing, and for NFTs as they move into the mainstream and go from digital art to real art and real estate, which has already started to happen, right? Those things already are happening. A guy sold NFTs to a country club that hadn't been built yet. It was basically the membership fee. He raised whatever it was, $25 or $100 million. I don't know, it was a big number. Bought the land and he's building a country club now. I think they overpaid for the country club membership, but whatever. They were first. They were probably rich already. It's a way to say I was part of this. Validate your existence in the world by what you do with your money. Yeah, right? That's all a lot of people do. Now, Bitcoin could bounce right here. We'll see. It's at a pretty interesting point where selling exhaustion is probably going to happen here soon. If we look at a shorter term time frame, go back to right before COVID. Yeah, I mean, I'll draw a line for you here. Shapes. Where's my shape? There it is. Horizontal line right there. That is a pretty significant exhaustion line. and it's right above where the 2017 peak was, 18, 17, 18, whatever it was. So when you see charts like this, and then the left side looks like that, you usually just scoop it off. Almost always rounds trip from somewhere around here to back to somewhere around there. And that's what it's doing. And it had that weird resistance spot right there. Oh, look at that. I didn't even have that up. Right about there. So I think you're getting really close. I think you should start scaling into Bitcoin if you want it. The reason I own ARK again is because you take a look at the holdings, right? Zoom, Tesla, Roku, Block. I don't love all of them, but they got so cheap. How can you not at least want to own them for a while? And that's the thing that we have to remember about ARK, is they don't manage the trades very well. They're buy and hold for the most part. I mean, they trade around the edges, but they're trying to buy and hold. So we have to manage the risk for ourselves. Just treat it like a stock holding. When it gets super cheap, you can buy it. When it gets gross and expensive, you have to sell it, right? Other mid caps. Yeah, QQQJ, Invesco Next Gen 100, goes along with the whole theme. It's very diversified. It's global. Number one holding is actually an oil company. It's Diamondback Energy, I believe. A lot of these are companies that will end up on the S&P 500. You could cherry pick them if you want, but this is a great way to get exposure. And it's close to bottom fishing. I mean, it just entered the buy zone. In the Invesco Midcap Momentum ETF, I want to show you this one. This is beaten just about everything. So this is how it's done compared to the S&P 500. Just beat the heck out of it. Now, in theory, momentum investing is ridiculously effective. Here's the problem with it in practice. I always think about Immanuel Kant when I say theory and practice. The problem in practice is making all the trades that you need to make in order for a momentum strategy to work. Here, you have an ETF with a supercomputer brain that does it for you. And it's not going to be as good as like Shooter and all the trades he makes. He's got a supercomputer brain too. But the computer basically does the trading for you and finds the best stuff. It just keeps rotating in and out of investments. And it's beaten the S&P 500 pretty handily. Still fairly correlated, but it just keeps putting a little bit more gap between it over time. So about the time that you want to buy bottom fishing on QQQ and QQQJ and ARK, which are all getting close, you could do that with this too. Maybe split your position up between QQQJ, XMO, and ARK. Maybe ARK is the trading position. On the clean energy side, PBW, again, diversified and global, pays a 2.6% dividend. And if you take a look at the holdings, what you see is that it's a lot of different things. Mining company, solar, another mining company, and it's what's called modified equal weight. It's not exactly equal weight, but you notice that none of the holdings are tremendously big, right? You don't have any 7, 8, 9, 10% holdings. So it's pretty diversified. 79 stocks globally. It's a good fund and it performs well. Again, you compare this to the S&P 500 and it beats it over long periods of time. So you can pick out almost any time period except a very short one, and PBW beats it, right? Well, I wouldn't really count this because there wasn't really an industry back then. I would look at the last 3 to 5 years. But again, this is another thing that wins in theory and in practice. TAN is if you want something more solar. I think that splitting up your position between PBW and TAN is a pretty good idea. Probably hold PBW and you can probably trade TAN. I don't mean trade it a lot. It's not like week to week, but quarter to quarter or a couple times a year. And then finally, here's the one that's going to be the shocker. I think it's probably time to buy EMQQ. Quick, duck. What did he say? I should have had my camera on. I actually ducked under my desk. Charlie Munger just bought Alibaba. Yeah, I know I'm a commie. EMQQ is about half China and half the rest of the emerging markets in the world. A lot of Asia. Well, what do we know about Asia? Asia is still loose on their monetary policy and they're stimulating. Do you know why they can do that? It's because their inflation hasn't been as bad as ours in the West. Do you know why that is? Because they've been planning for it better. They're more technology based. Japan's been dealing with aging demographic issues for 40 years. They're ahead of us. Just like they have 5G way ahead of us. Be a lot of growth over there. We need to get a piece of it. With the dollar being strong, we're right on top of needing to do it. And in fact, I think that if I had to tell you to make one investment today, other than QQQ, EMQQ would be the one. Start scaling into it now. So like I've told you, eventually China wants to make money too, and they have to back off on some of their tighter policies. What was the rumor that we heard last week? And Alibaba might still do the Ant deal, revised, but do it. Look what's happening here. It's gotten into a jitterbug zone. EMQQ is probably by the dips. Does that mean it can't go down to 24-ish? It could, but it may have already sniffed the bottom. We'll see where this retraces. I think you should get a taste because it pays a dividend. It's international diversification. It's high tech. It's growth. Really good balance sheets, actually. When you take a look at the companies in here, these are not broke companies, right? These are not broke companies. They're profitable. There's 141 of them, but your top 10 holdings make up 65%. So the rest are just meh. You take a look at these 10 companies. Mercado Libre is a big deal. Baidu, NetEase, all the way up. And I think I might supplement this with a Indian fund of some sort, right? What was the symbol for the Indian fund that we use? The small cap Indian fund. It's SMIN. Yeah, I want to say SMID. I was close. So this is another fund that we could probably take a look at. It's not quite to where I want it. I'd like it down here. It's on the VSL. So we're not quite there yet, but we're close. The benefit of India, and it's not very well represented in EMQQ, is that they're young. They're technologically advanced, and they're buying cheap energy from Russia, which people don't like, but it's going to be good for them. Metis is over there too, so why not? Now, could you use FMQQ if you just don't have nothing to do with China? You could, and then you probably want to wait just a couple more days or weeks. FMQQ is the same as EMQQ, but no China. But if Charlie Munger is buying China, and I don't think anybody would accuse him of being a commie sympathizer, you just have to say, well, am I willing to do this or not? Is it in my ethical profile to make money on this? Do I want a piece of the emerging Asian economies? Probably going to be the fastest growing in the world the next 10 years. So I'm biting the bullet. I think I might even just take like a 1% position in EMQQ. All right. Somebody asked about Bitcoin trust. Oh, by the way, dollar is up a lot this year. Okay. It's up a ton. It's like 16, 17%. So when you see those articles about cash is trash, just scratch your head and say, man, this guy doesn't know what he's talking about. Because even adjusted for inflation, it's up by 6%, 7%. And this is going to be something else we talk about. Petrodollar is dying. Doesn't mean the dollar's dying. Dollar's just going to go a different route. Digital dollar is coming, folks. The dollar might be in a new higher range. I think I'll pull back in here soon. You get a good bull market. But ultimately, the dollar drifts up. And with the minimum corporate income tax and states being able to tax weed and replace all that money from cigarettes from years ago, as long as they don't spend new money rich, they actually run balanced budgets, you are going to see some ridiculously good things happen in the United States over the next decade. I think we're going to get a mega economic expansion in the areas that I talked about. Everything else will be flat or slightly declining. But in the areas that I've talked about, fourth industrial revolution technology and clean energy, anything related to those things, from industry to the actual tech companies, right? Industries that use technology well, great place to be. Somebody asked about Bitcoin trust and should they put it into an IRA? Again, this is one of those things that you have to be a pretty good trader on. And with this, there is a pretty big discount. First off, I don't expect them to allow it to become an ETF soon, maybe eventually, right? This is a different type of trust. You're getting a discount to Bitcoin. So if we compare it to Bitcoin, there you go. So this is trading at a pretty deep discount. It should close the gap when it starts going back up and as more people adopt it. So if you wanted to trade the Grayscale Bitcoin Trust on the idea that there's a rebound and more adoption and wait for that gap to close between the two of these, you could play that trade and probably beat Bitcoin by 10, 20%, but only for those months or quarters that it's happening. The best place to invest in Bitcoin is to own Square and Marathon. So Marathon is a leveraged version and Square is a leveraged version of owning Bitcoin. What do I mean by that? Marathon Digital Holdings, which to me is a buy. I mean, can it get cheaper? Yeah, it can always get cheaper, but it's already a buy as far as I'm concerned. They own a ton of Bitcoin. And on a balance sheet, it's just like gold, right? Gold on the balance sheet of a miner appreciates in value when the price of gold goes up. Same thing happens with Bitcoin, except they don't have to store it such an expensive way. It costs money to store Bitcoin, but not anywhere near what it costs to store gold bullion. So I think that Marathon Digital is probably a 10 bagger from here. If I'm right that Bitcoin goes to 100,000. If I'm right that eventually Bitcoin gets between 3 and 500,000 on a spike, oh my gosh, this might be a 50 bagger. So if you have risk capital, money that you're like, I'm willing to take 1% of my money to put it here because it might turn into half my money, this is one of the places, along with Metis and just a few others. All right, let's call it a day. I need lunch. I got all kinds of top 12 lists right for you, and go from there. Make sure you take a look at the I had it in here somewhere, the Global Trends ETF report. It's also it's right there. Take a look at this because I have pretty good price points. And I think, like I said, I think in a lot of cases we've blown through the first potential starter position. It's like QQQ is closing in on 255. So that's why I say I don't think it hurts you to take a little position in QQQ today, right? And then if it falls all the way to 220, back up the truck. And we might not get perfect bottoms. And when things are happening, I'll do meetings like this and we'll catch up, right? Because all you can do ahead of time is have an estimate, and then you try to get closer in real time. I don't think it hurts you to take a starter in BST. Is it on? Yeah, it's under 35 now. I mean, it's got a huge yield and it pays monthly. It's a good holding. If you're retired, this is a spectacular holding. They do the option selling for you. And again, this is why you should love it. BST, SPY, and put in the real estate index too. All right, let's look at it over 5 years. Look at that. Real estate on the bottom, SPY, QQQ, BST. Excuse me. BST is orange. So you can get QQQ-like performance of BST, which has some S&P 500 companies in it that aren't in QQQ. BST is just a tremendous holding with a 8% plus annualized income paying you monthly. Man, if you're a retiree and aren't buying BST with a low double-digit percentage of your portfolio, 10, 12, 15%, again, you can't complain about not getting income and growth. This is a great holding. Great holding. Trailed a little bit lately, but over the long term, pretty neat, right? And I do think that going back to 2016 is where we should generally start. That is the worst it could get. The worst the things could get is that we get down to 2016 prices. I don't think it's going to happen. I think we get down to 2020 prices, top 2020, January 2020 prices. I think that's where we're headed. And we'll figure it out when we get close. One other thing, tomorrow, and even again, I haven't looked at the chart here since I've been talking. Going into Powell, I can't imagine he's going to be anywhere near as bearish as people think he's going to be. I mean, you have to come right out and say, I'm trying to destroy the world for him to be as bearish as people think. And that tells me that you should nibble something this afternoon. QQQ is the easiest. EMQQ is hard, but probably makes sense. A couple stocks that you don't already own. Go take a look at the plug and play. I am removing Kazoo, not because I don't like it. I think it's going to be good, and I'm not going to sell it. I'm just not going to add to it. I like the satellite stocks. I like New Fortress Energy. I like Metis. I like Ford. I like Ginkgo Bioworks. AT&T, if you're a retiree, it's a great retiree stock again. I've got a surprise stock that I'm adding to the VSL when I get back. It's a generally well-known company. Has something to do with electricity, kind of. Used to anyway. Now they make jet engines that can run on biofuel. Jet engines that run on biofuel. Well, that could be good for a company that we know about. Anyway, I'll let you figure out who that company is. I'm not ready to buy it, but I said back when that particular stock was around 30, that would go down to the teens and stay there a long time. And I think it's about done with the teens. I think it's gonna some point get into the 20s and 30s again. And if their dividend ends up being a good dividend policy, I think it'd be good retiree stock, because I think that basically every airplane in the world's got to be replaced in the next 30 years. So that'll be pretty good for them. It's a long ramp. All right. Have a good afternoon. If you're in the heat wave, stay cool. If you're about to get wicked thunderstorms like it looks like we are, stay safe. And don't panic. It's too late to panic. Now you just have to upgrade your portfolio if you didn't accumulate enough cash. And if you did accumulate cash when I told you to, super slow baby steps. I think you can start with EMQQ and QQQ today. Have a great rest of the week. I will see you on Thursday.